Folks, we've got a big problem, and its name is homeowners insurance. And not enough people are talking about this. And whether you're a young person hoping to save up money to buy your first home, or you're a young person that owns a home, or whether you're retired and you thought you had your costs contained and you knew that at a minimum, at least you had a roof over your head. This is impacting all of us. And so in today's video, I want to share with you what's happening, potentially what's driving it, and then most importantly, what we can do to protect ourselves. So let's jump in. I've got a few articles I want to share with you. The first one's from Insurance Business, and the title is Homeowners to Face Huge Premium Jumps as Insurers Seek 50% Premium Hike. And there's a quote in this article that says, I think this is pretty consistent about what you're going to see across the board. So not good news. This is not just Florida. It's not just California. We're seeing this spread. In fact, stay in the video. I'll show you the states that are seeing the largest price increases. And I'm also going to share with you the states that have the highest home insurance rates in the country right now. Okay. So let's start there with where the rates are likely to increase the most. And this is an article by Realtor Magazine, and it's called States Where Homeowner Costs Are Surging the Highest. And before I go there, I just want to share, one of the things that's happening is homeowners insurance used to be fairly affordable. It used to be fairly predictable for the insurance companies, and few of us really had to worry that much about our homeowners insurance. But now it's becoming a larger and larger expense at the exact same time that our groceries at the grocery store costs are going up, that it costs more to eat out, it costs more to repair our cars, it costs more to maintain our homes. Everything else in life is also getting expensive. But this is more than just inflation increases. These are dramatic increases. So let's go back to this Realtor Magazine, where insurance costs could rise the most. Number one market is Louisiana. The predicted change in 2024 is almost 25%. Maine is projected a little below 19%. Michigan is expecting to see a 14% rate increase. And remember, as I record this, inflation is in the 2 to 3% category. So something else is happening. Let's keep going, see if your state's on here. Utah, unfortunately, the rate increase is over 10%, 13%. Montana is 12%. South Carolina, 11%. North Carolina is projected at 10%. Illinois is projected at 10%. Connecticut is projected, the rates are projected to increase by 9%. And it's the same thing for Nevada. Okay, so as I said, I'm going to share with you what the insurance costs are by state. But first I want to go into why experts think that rates are increasing. And there was this really interesting article. It's got a little bit of a political bent. My channel is not political, but I thought there was one quote in this article really worthwhile that would be helpful for all of us. So let's dive in. The article is called Housing Insurance is Melting Down in Several Property Markets as Climate Change Renders Old Assumptions Obsolete. And it's written by Spencer Glendon and Barney Schobel. And here the article goes on to say, put succinctly, the first time a property floods, it's an insurance problem. And maybe even the second time. But after that, it's an equity and debt problem. And what they mean by that is, right, as homeowners, we're the equity holders and the debt holder is our mortgage, so it's a bank. So they're saying that, third time a property floods, maybe it becomes uninsurable. I'm not saying it does, and if it is uninsurable, then it's the bank that's taking the risk and it's you and I that are taking the risk. So that's what they mean by that. And this is the quote that I think is insightful. It's important to understand that insurance is not protection against hazards like flooding, wind, fire, or hail. Rather, it's a financial contract to reimburse property owners for the cost of repairing structures only after events that are predictably rare. If hazards stop being rare and stop being predictable and or produce damages that are not easily repairable or suggest that a building shouldn't be rebuilt in that location, then the existing market for both property insurance and property more broadly won't work. So what they're saying is the reason the insurance market works is because these are rare instances that the insurance companies can predict both how frequently they'll happen and then also what the cost will be if and when it does happen. Okay, then the article goes on to say that past patterns and ranges of weather that repeated over time enabled a huge, reliable property insurance market that relieved asset owners, you and I, and lenders of estimating and preparing for events that had a low probability of happening. Not only could specialists assess events that had a 1% probability, a 1 in a 100-year event, but they could also anticipate the damage that those events would cause. That's essentially what the market is. It's predictable events that you can predict the frequency and also the cost of repair. And this is what's driving the problem, what I'm about to share. A few years ago, sophisticated users of climate and weather models, notably reinsurance and insurance-linked investment funds. So the people we deal with, you and I deal with, the insurance providers, they have reinsurance. So the insurance companies are actually insured. And what this is saying is those reinsurers are pulling out of the market. The article goes on to say the reinsurers began withdrawing from some markets. Their retreat left the insurers that you and I deal with unable to offload their risk, just as the probability of those risks were increasing. In turn, insurers, most of whom are prohibited by regulators from rapidly increasing their rates, have begun to retreat from markets, especially Florida and California. In response to that, governments have set up what they call insurers of last resort. In Florida and California, they're state-run insurance groups. And it's to be expected that these state-run groups are not immune to the same facts, the same hazards that are happening. And so these state-run institutions are also having to increase rates dramatically. So one question is, what happens if you can't get homeowners insurance? Hold on to that thought, because I want to share with you the cost by state of some of the most expensive markets, and then share my thoughts on what happens if you can't get insurance and what it means for people in all three of those categories: a young person hoping to buy a home, a younger person that has a home, and then people that are retired. But first, let's look at the cost by state in the most expensive states. The most expensive states starts off with Florida, where it's currently at about $11,000, and next year they're expecting that to go up to $11,759. Louisiana, a little under $6,400, expected to go up to $7,800. Texas is currently a little under $4,500, and that's actually stay pretty stable next year. Mississippi, also supposed to stay pretty stable at $4,000. Colorado at about $4,000. Nebraska at about $4,000. Alabama at about $4,000 a year. Kansas closer to $3,500 a year, and then Arkansas a little under $3,500. So those are the expenses by state in some of the most expensive states. So in Florida, it's expected to go up almost up to $1,000 a month just for homeowners insurance. That's a big, big expense. So what do? If you're a young person saving up for a home, this is just a reality. And a young person that's saving up 10 or 20% for a home, you're going to need insurance. So it's just a reality. It unfortunately means you need to be saving even more money than what you are now. Somebody that's already an existing homeowner, one thing to think about is maybe moving to a state where they have less expensive and less likely events to happen. Places, outside of Florida and California, and people on that expensive list. So one thing to think about is doing that, but that's not an easy thing to do. You live where you live for a reason. So again, it's getting harder and harder to save money and to take our hard-earned paycheck and cover all the bills, let alone save for retirement. But it's just a reality, and really the only thing to do is either sell your house and become a renter, or move to a state that has lower cost insurance, or just budget for the higher costs, unfortunately. And then if you're retired, right, owning a home, owning your home and having your roof over your head gives a lot of peace at night factor to know that you're going to be okay. And unfortunately, the cost of that security, the cost of that warmth, the cost of that good night's sleep continues to go up. And it continues to go up because there's cost, even as a retiree, that's out of your control. You've got the cost of taxes, you've got the cost of homeowners insurance that we talked about, and then you have the cost of home maintenance. And unfortunately, the cost of home maintenance is going up as well. So those are the facts. I don't like being the bearer of bad news. Unfortunately, I was on this one. But I want to be the bearer of good news on this video up here, where I talk about when should you think about retiring and why maybe retiring at 65 might be a big mistake. I'll see you in that one. Thanks for watching this one. Bye-bye.